Why the stock not growing? I don't know, man.
I mean,
These questions make me want to sell my shares.
I know. Ladies and gentlemen, welcome to the SOFI Weekly. I wanted to have a quick little conversation with you guys about the SOFI shareholder Q&A, seeing what people have to say or ask Anthony Noto and Chris Lapointe. This is on Monday. This was the Q&A. The top question with 990 votes is when the company will be profitable.
Waste of a question.
it is a waste of a question.
It's a waste of the most upvoted question. Do you plan to deliver dividends to shareholders in the future? Like, these are going to be, okay, Q4. Yeah, we don't know yet. We will tell you as that comes along. Chris Hager actually has the first great question here. When you acquired Technisys, you guided for 85 to 100 million in savings between 2023 and 25. Can you give an update on how that's progressing and when we can expect to see products like checking and saving and credit cards using Cyberbank Core? And also, I think that is the most upvoted in terms of share count than any other question. It says here, I've never used Say before, but it says there's 8.25 million shares represented, and the highest voted question is Chris. And I think if you actually change this to by most shares, Chris is on both 5.7 million for this question and 6 million for this question. So,
well, at least Chris asked good questions, I would expect nothing less from him. Yeah. And the people that asked when are they going to be profitable and when are they going to pay dividends, waste of questions, and why any SOFI shareholders would upvote those is crazy. We know the answers to those. They have no interest in paying dividends anytime soon, and they're going to be profitable this quarter. And if they don't, they better have a good excuse why.
Why the stock not growing? I don't know, man.
I mean, these questions make me want to sell my shares.
I know.
I was gonna say some of these questions just make me want to be like embarrassed to cover this session on Monday, you know?
Jacob says, you're a fintech company. What are you doing differently than just being an online bank? Why don't you follow an investor presentation? Because they've covered all the things that they've done so far.
Yeah, like literally any fireside chat throughout this entire year would answer 80% of those questions, like from profitability to all the business segments of like what SOFI does and what differentiates them, so on and so forth. 130 million shares sold short. Michael Rowland posted this on Tuesday. There was only one other reporting this entire year that was higher from an aggregate shares sold short. That's a tongue twister. And that was on June 15th, which was 132 million. And as of November 15th, the number was 130 million. But basically the gist here is that the amount of shares sold short has been increasing throughout the year. And I haven't seen the November 30th filing on the NASDAQ site, but as of November 15th, we're at 130 million shares, which I believe is about 14% of outstanding shares, 13%, something like that. It hasn't been updated yet for November the 30th. So the short interest there has been increasing throughout the year. So we started off in January with about 89 million shares and eventually crossed the 100 million shares threshold to the point where we sit now at 131-ish million shares sold short.
As a percentage of the overall stock, it's not the highest it's ever been because obviously we're getting diluted over time. So I think we've actually been a little bit higher on a percentage basis before, like 14% versus now it's like 13.6 or something. But still, yeah, people want to bet against it, but that doesn't necessarily mean that they're right.
I think the interesting part as well is that the last time this topped out, June 15th, was about 1.5 months before the Q2 earnings. If you were to plot those numbers on a line graph, it saw a peak 1.5 months out. And then as we were heading into the July earnings, and especially after the July earnings in August, that number, fell to about 100 million shares. And now we're starting to see a resurgence of that same trend as we head into the Q4 earnings as well.
It doesn't personally bother me. I think that I have my conviction and they have theirs, and we'll see at the end of the day. But yeah, it's just a matter of seeing who wins. I don't necessarily think that more capital into shorting necessarily will bring the stock down on its own. I think that we'll need to actually see a bad quarter. I don't think that happens in Q4, that's for sure.
Yeah, look, I think that a lot is riding on profitability. It's one of those known factors. And there is that idea that people will buy the rumor and sell the news when it does come. There is that idea that People have seen previous trends around SOFI surging and then giving it all up after earnings reports, that they want to ride that high. I've been looking at a lot of technical charts, and then also we can talk about the macro. I do think that the company has started, the stock, I should say, has started to build a strong base in the high sixes, low sevens. And it's just going to get harder and harder to break through that. It forms sort of a floor, especially going into like a big catalyst. I've said time and again over the last couple of months, yeah, sure, profitability is sort of the headline that people are going to be looking at. But for me, the biggest thing that I'm going to be looking at for this upcoming earnings is the 2024 full year guidance that they're going to give, because that's something that we can extrapolate and project out from in terms of where we can see this company in the new year. Profitability is something that, you know, we've been tracking since the beginning of the year. Way back in January of this year, they said, oh, we're going to be profitable by the end of this year. And we all had that in our mind to say, okay, let's work backwards to see how they can get there, what needs to happen. And while everybody may look at profitability to say, you know, does it happen, does it not happen? What I'll be looking at is what is the next promise that they're going to make for the end of 2024?
No, I think it's all going to lead into guidance, right? Like, are they going to say what they said about contribution profit, saying, hey, this will be profitable for the foreseeable future? If they say that about GAAP net income, I think that's going to flush away a lot of the skepticism, because obviously management has been very positive and strong. And even the thing about like buy the rumor, sell the news is like, no one's even buying the rumor. So
I wouldn't say no one.
I am, but the stock is not running like all the other fintech stocks out there. That's for sure. I was just reviewing some of these stocks. I was looking at ARC's company, the Cathie Wood's fintech thing, ARC-F, is up 36% over the last month. Shopify is up 56%. Square up 61%. StoneCo 65%. Lemonade 67%. Coinbase 73%. Affirm 114% in the last month. SOFI 3.7%. Definitely some running to do comparatively to other names, but yeah.
Let's cover the credit card thing. Eventually, I want to circle back to the Apple and Goldman news, because I think that's an interesting conversation for us to have.
Credit card products is the purple line here. This shows off that between Q4 of 2020, we only had 6,400 credit card signups, to today where we have 236,000. Credit cards in the financial industry are some of the highest returning ROE than any other financial product. It is an amazing product if done well. It's what allowed Capital One to succeed so incredibly fast, and it's what allowed Nubank to succeed so incredibly fast. The debt per credit card, however, has been going down a little bit versus previous quarters, just as we maybe limit certain people but add new members. So we're hovering at about $1,049 per member in terms of credit card debt. I'm going to quickly scroll past that sheet right there and go to this one. This is the amount of loans that we hold for investment from our credit card lending. The orange line here is default rate. Back in Q3 of 2021, it was 7.5%. Then that climbed in Q2 of 2020 to 11.4%. Then in Q4 of 2022, 20.37% annually. That has been dropping quarter after quarter after quarter to 18%. But whenever comparatively to other banks, this is 3 times worse than their competitors. I would probably say it's in a comfortable range of like 6%. JP Morgan's, I think, is even under 4%. And obviously, as you deal with less affluent clients, are going to have higher defaults and higher coupon rates, so it might even out, but still 18% is nowhere even close. You're talking about offering clients up to an average of about 25% on APRs, maybe on average like 22%, somewhere there, and you're defaulting 18% of the time, not including cost of funding, which is probably another 4 to 6%. It's just a money-losing product right now. What's going on in the credit card business that's doing so bad comparatively to all the other products that SoFi is doing in the investing space?
To what degree could this just be the fact that their total pool is so much smaller than JP Morgan? If they have 250,000 credit card products in general, the total aggregate number of defaults as a percentage would be much higher, whereas JP Morgan could have on an aggregate basis 10 or 50x that number and still be single digit percentages, just because they have a gigantic pool of total clients.
Law of large numbers, in a way, that assuming probably anything near 250,000 users would kind of average out to to a pretty good like ratio. Of course, 20% would be normal if we had 6 credit cards. You know, we have 250,000. I would assume that it gets kind of averaged out at that point.
Does it get averaged out at 250,000 or 2.5 million or 25 million? At what point does it start? Let's say it's 30% when you have 25,000, and then it's 20% when you have 250, and then it's 15% when you have 2.5 million, so on and so forth. Eventually getting to the JP Morgan size of it being, 4%, something like that.
I'll show you one more chart on the FICO scores. This is the main chart. I think this is sort of by far the most important chart that we can show off per loan. So looking at the total size of the loan book divided into their own FICO cohorts. The lowest FICO score, less than 640, is by far the largest. And it wasn't back in Q4 of 2021, but it was in Q1 of 2022. Do you guys remember any specific event that happened in Q1 of 2022?
Bank charter?
Golden Pacific Bancorp. We acquired them right here. And my assumption is that they came with quite a sizable credit card business line. That, I think, is quite normal if we were to acquire some of their debt, right? Whenever you acquire an entire company, you get all the good and bad eggs. My problem here is that from Q1 of 2022 to Q3 of 2023, the total credit card loans by FICO more than doubled. There are some things like if you look at the 800 plus has been growing quite substantially.
Do we know how big their credit card business is and as a percentage of revenue compared to everything else?
Tiny.
Right.
Tiny. I'm not saying that this is a killer for the business. That's not what I'm stating at all. I mean, even if you include contribution profit for financial services, including credit cards, including all these things, we're still profitable after paying for all these defaults and everything. But they did say credit cards are by far their largest losing business. They're not making any money on it right now, but they're stuck between a rock and a hard place, in my opinion, because if you want to be a one-stop shop, you're offering a credit card. You can't kind of step away from that.
They're pretty stringent with their credit box. Credit card is by far the loosest in terms of the FICO requirements, because I know for student loans, personal loans, the FICOs, like their credit box starts above 680. But for credit cards, they do accept people with worse credit. Yeah, sure, we can drill down into the numbers and say, okay, this trend is not good. But in the grand scheme of things, you've mentioned it in the past around home loans, right? Like there's some segments of their business that are just frankly unprofitable right now. Despite that, SOFI needs to offer them in order to be a one-stop shop. Like that's their moat, right? Their ecosystem. Yeah. It's similar to the news around SOFI discontinuing crypto, which was announced this week as well. People were like, oh, wow, SOFI's discontinuing crypto. That's horrible. But then when you actually look at the contribution to their revenue, it was less than 1%. It was like single digit millions of dollars when they reported $500 million in terms of revenue. Even if the trend worsens for credit cards, and it seemed to have been getting better from an average balance perspective, they're eventually going to move towards being unit economic positive for that segment. But even if the trend continues for another couple of quarters, hell, even another couple of years, it will more than be offset by the profits of the other segments. And it's important for them, regardless of whether they're losing money or not on the credit card segment, to offer it just for the sake of being an ecosystem. These are things that like I could see bears pointing at this chart and saying, oh, like this is a bad trend. But just looking at, the forest for the trees, you can say, okay, well, it doesn't really matter because everything else like will carry credit cards on its back, just like the crypto news, right? They removed it. It's less than 1% of revenue. Realistically speaking, it doesn't matter.
The part that gets me really excited is that it's not like they created a new product line that's doing poorly. They are doing poorly on something that historically has been one of the greatest financial products ever invented for banks, right? The credit cards. And so my belief is that they can make a lot of improvements on this if they actually pour more money into it, get a better underwriting team, these sorts of things. So I do see them getting significantly better in this area over time. I'm still very positive. I just also think if they could bring down the default rates, what could they offer in terms of rewards or something like this? Like if you're paying out 18% or writing off 18% because of defaults, and you're offering 2% cash back, it's like, if you could improve that by 10%, because that's what I want them to do. I wanted them to cut it in half. You could offer probably 3% cash back at all times, if not more, and actually be a fully profitable segment for their business. So not only are you bringing it in as a loss leader to get new customers, but you're acquiring customers for profit. It doesn't even have to be a loss leader.
As a percentage of their total financial services product, credit cards is like 2%. Invest is 10x bigger than credit cards from a products perspective. Money is like 15x bigger than credit cards from, a products perspective. So I really do think we have to take this with a spoonful of salt.
I think that the reason why you've seen no real growth in credit cards is because they're not pushing it right now. You're not seeing accelerated growth like you are in SoFi Money, where you're seeing 100,000, then 200,000, then 300,000 over time. Right, they're pushing that exponentially.
Yeah, but obviously, right, they're not going to like push their unprofitable, like riskiest line.
Yeah,
but the fact that they have it in their ecosystem, it's good for them.
It doesn't matter is the bottom line with the credit cards. It's a loss leader, gets people in the door. Eventually, it'll pay off. We're going to have way more people on credit cards in a few years from now. And look, so much information moves at the speed of light now because of social media and just everybody's 24/7 with their phones, and information never used to flow like this. Worry about the bottom line number. If we become profitable, we achieved everything we need to achieve this quarter. Doesn't matter if credit cards are losing money right now or not. As long as the company is growing, as long as they're delivering, and we are meeting the metrics and the guidelines that management is outlining, it doesn't matter.
Can we move to the Apple Goldman news? Because it's by far the biggest, I think, news impacting SoFi this week indirectly, but still the most interesting conversation topic, I feel.
It came out in June. That's what's crazy, is this news came out in June, and now they put out another article saying Apple and Goldman are breaking up. This is the next report, the next rumor. Still hasn't even been official, but from Apple's perspective, it's another rumor once again, but that they want to break up. People are saying that my points are mute on this SoFi Weekly, saying that Apple is a competitor in the fintech space.
They're not a competitor in the fintech space.
Okay.
And I am a little shocked about this. And I would think that Apple's either going to fund it itself or find a new partner if Goldman does back out, because the Apple Card creates a lot of synergies for their ecosystem, especially with buying hardware and everything else. I don't know. I don't see Apple getting rid of it.
There was obviously conflicting reports depending on, whether you go to the Wall Street Journal or wherever. I think Wall Street Journal was the one that just broke this news, at least this time around. In June, it was a rumor from Goldman's side that they'd lost $1 billion in a year, basically, on the back of this Apple partnership. And they were looking to get out. The update, I guess, this time around was that Apple had officially given Goldman a proposal to find the next partner within the next 12 to 15 months.
Yeah, but they didn't release any statement to the public. There's nothing like official where.
That was the new piece of information. We didn't have the 12 to 15 month proposal on the table, regardless of any official statements. It's just like we're getting spoon-fed more and more information around this behind the scenes.
The breakup will happen.
Absolutely, but I don't think Apple would, go ahead and announce something if they didn't have another partner, at least in final discussions lined up.
Do you guys think SoFi is going to be that partner, or what's up?
You know what? Honestly, I think that if anything, Amex is going to be the partner. It just makes, I guess, the most sense for me.
Yeah.
But even Apple is a behemoth, man. It's just so difficult for anybody to support Apple's infrastructure and just the massive amount of users that they come on board with, just as a result of them having iPhones. Like, they have a entrance in everybody's household, right? My confidence interval on them finding a partner is maybe 50-50 right now, because I'm sure Amex wants that business, but after seeing the giant Goldman losses, it seems tough for Apple to find any partner at all.
Yeah, but what do you mean by they're not going to find a partner? Every company is going to turn down Apple with these conditions, but you don't think Apple, if they can't find a partner, that they will say, okay, fine, you guys can make the requirements up for who gets underwritten?
So this year, and I don't have it in front of me because I am leveling right now, but they made their fiscal year ends in September. $96 billion in net income this year, $99 billion last year. If they have to find a new partner, they can tweak the deal differently and absorb a fraction of the cost if they feel that keeping credit cards is in their best interest. If they want to find a new partner, they'll find a new partner. And Absolutely. It probably would be Amex. The only reason I say that is because Berkshire is a major shareholder of both companies.
Obviously, they're going to have to massage the deal and work out some favorable terms for another partner. But the reason I say it's going to be difficult for them to find a partner, Tannor, is not that nobody wants Apple's business, is that Apple's scale is so gigantic that you only limit yourself to 3 companies.
Potentially. The big concern with Goldman Sachs is that they bullied Goldman Sachs down to such a low margin and forced them
Goldman couldn't make Marcus work. It's just not what they do.
I get it. But they,
it's not their main
business.
It's not what they do. I'm not surprised. Like, they are great at what they do on the other side. They just haven't made this type of stuff work.
What I will say is that from what I heard from the Goldman Sachs thing, they were forced to write all the clients and have their billing on the same date, first of the month, which made them have all this customer service issues right at one time of the month and then not be able to spread that out. There was hard capabilities to deal with that. A very low underwriting standard because Apple wanted to accept everyone onto this credit card, which makes it ridiculous. Why not just do a secured credit card? Why offer them actual credit if you're wanting to go with everyone? Not everyone will pay it back. That being said, if Apple's about to lose this card and no company is willing to give Apple the deal, are they going to throw out the Apple credit card, or are they going to bend their parameters a little bit?
Yeah, I think the worst case scenario for Apple is that they're forced to withdraw from that initiative altogether. That said, though, I do think that there is some type of middle ground. Like, let's say they're going to rework the terms of the deal and find another partner to go with. They could just overall reduce the importance on the fintech aspect of their business in general and turn their focus to some other growth driver for their business, right? Like, I think this partnership with Goldman can be seen as a deterrent, right? They signed a 10-year deal that they had to back out of 3 years in.
They can definitely bully companies around and push their weight around, but I do not think that they give away this card. And I do think that they're a competitor to SOFI. They offer a high interest savings account that has more deposits than SOFI, and they did it in a faster amount of time. That is a real deal.
They got more deposits than SOFI in a shorter period of time, or the same period of time, for the simple fact that look at their ecosystem and look at their brand awareness and look
that doesn't matter.
Loyalty. Of course it matters.
Why does that matter?
People line up still the day that the iPhone comes out, or they have it on pre-order and shipped to them. They have such a loyal following. I know several people that no matter what product comes out, unless it's the big tower, they get it.
That matters zero. Who cares? Like, just because they're a big company does not make it so then SOFI has less competition. If the ecosystem is so strong that people are willing to use all their products, then they're not going to use SOFI.
The reason that they were able to scale so big in the savings is because of their brand awareness and their loyal following.
Brand awareness is one thing, but I also think the ecosystem itself, like Apple has a Trojan horse in the household of half of America, basically, and that is the iPhone. And the iPhone, they can basically deploy any type of software that they want to the iPhone to instantly onboard you onto whatever credit card or savings account or app that they really want to be pushing from their team through that hardware. And so that network that they have is really a secret weapon that a lot of these competing banks, SoFi included, is really difficult for them to actually stay in the running for that, because Apple can say, okay, everybody who has an iPhone or everybody who buys an iPhone, here's a free savings account, we'll load it up with XYZ. Like, they can go and make these creative campaigns to onboard new people. Now, sort of like a secondary effect is that Apple is the largest company in the world. Them entering a space that SoFi is in will, to a large extent, validate that space to say that if Apple onboards all of these young people, all of these new people onto this ecosystem through their UX, there is going to be a percentage of those people who are going to be introduced to this world. And as a result of that, they're going to be looking to jump to their next thing or opening a new card or so on and so forth, that have now an increased probability of finding SoFi through their APY as a result of Apple having onboarded them into the ecosystem in the first place.
But remember, the Apple ecosystem is a one-trick pony or a two-trick pony. It's savings and it's a credit card. It doesn't have the ecosystem that SoFi has. It's two completely different types of customers.
Probably about a year ago, where people would say it's just a credit card.
If it's just a credit card,
it's just a checkout. They also have buy now, pay later. So now they're in lending.
It doesn't have buy now, pay later these days. Everybody has buy now, pay later.
All the people that have buy now, pay later, I call fintechs. You stated that they're not a fintech.
It's a buy now, pay later is not a fintech thing. It is a financial thing.
Tannor, can you throw up this comment from 1044 from his MM? The comment says, can't Apple just buy a company? I think this is an interesting branch of this conversation. The partnership route, I think, is an easy route to take, with Goldman or Amex or whoever else. The other alternative is for Apple to buy a company that has a bank charter. I don't think it'll happen either.
I don't think Apple wants to deal with those types of headaches and having to deal with regulatory from a bank and compliance standpoint. Why would they want to? It's much simpler and cleaner on their end if they can just partner with somebody instead of having to build that out internally. It's just not what they do.
I think it would put them under some regulatory, putting a little bit of a spotlight on this company where regulators get to kind of look at them. Like, if you actually actually think about it, PayPal doesn't even have a bank charter in the United States, and that is a fintech. They are a digital wallet. They are a payments company. They do trillions of dollars of TPV, and they don't want a bank charter. So Apple definitely wants to stay far away from that.
I don't see it happening.
Yeah.
So as a result of the regulatory scrutiny, you guys think it's much more likely that they'll just rework the terms of the deal and absolutely find a partner?
I think
I think they'll take
in their best interest to find a partner rather than go at it alone.
I think it deepens their ecosystem and keeps people on the iPhone longer. Like if you have your savings on Apple, you're not switching to Android anytime soon. That alone is worth it for them to just re-up on the hardware, so they don't need a large margin for their fintech products. If they can have their cake and eat it too, they will. But if Goldman is about to cancel their contracts and Amex doesn't want a piece and no other vendors has the size or capability or want to do it, they'll lower their margins to keep the ecosystem. That's my belief.
And it also, the same thing that Tannor said about Android, it's the same thing with Windows, that they give, I believe, a discount on hardware through their credit card and they offer terms on payment. I mean, it just makes sense because it helps keep people in the Apple ecosystem, makes it more sticky. The credit card is actually a brilliant credit card for the simple fact that it does not have a numerical number on it. And it changes every time you want to use it. So if you have to give the credit card at a restaurant, nobody can write down your credit card number and take your information. I mean, it's a genius idea.
The tokenized cards are becoming the new normal because the security on them is just crazy. So
yeah, I mean, it's great. I wanted to get one, but I ended up being lazy and not doing it.
Any other news in the SOFI or fintech ecosystem? So maybe we can save that for the after hours show if you guys want. Let's save that for the after hours show. Ladies and gentlemen, this is only for the paid members of either Tevis or my channel. You guys are also welcome to join, or anyone else that joins up on the things. You guys can just hit that join button down below. But aside from that, appreciate your time.
I will say one thing. What you guys see on the SOFI Weekly is very restrained and PG Steve.
Yeah.
But, on the after hours, it's a whole different story out there.
Yeah, and I'm going to leave it right there before he starts cursing. Okay, goodbye.
No, I'm not going to curse, but I was